Gold hits one-week peak as Venezuela turmoil sparks fresh safe haven buying precious metals, climb as geopolitical shock. Easing rate expectations and global uncertainty converge. Gold prices jumped sharply on Monday, reaching a one-week high as investors rushed toward safe haven assets following a sudden escalation in geopolitical risk tied to Venezuela. The yellow metal rose 1.9% to $4,411.14 per ounce, reacting to reports that the U.S. military carried out a surprise operation over the weekend that resulted in the capture of Venezuelan President Nicolas Maduro. The shock reverberated across commodity markets. Silver surged 4.4% to $75.82 per ounce, while platinum climbed 2.2% to $2,190.55, reflecting a broad move into assets traditionally seen as protection during periods of political and economic stress. Market sentiment shifted rapidly as fears grew over regional instability and the wider implications for global geopolitics. Investors once again turned to precious metals as a hedge against inflation, currency risk, and geopolitical uncertainty. Developments in Venezuela have reignited demand for safe haven assets, with gold and silver benefiting most as investors seek protection from geopolitical shocks, said Tim Waterer, chief market analyst at KCM Trade. Gold's exceptional 2025 performance extends into 2026. Monday's rally builds on gold's remarkable run last year. In 2025, the metal gained nearly 70%. Reaching historic highs above $4,550 per ounce, its strongest annual performance since 1979. That surge was fueled by aggressive central bank buying, persistent geopolitical tensions, and growing expectations that U.S. interest rates would eventually decline. Now, with fresh uncertainty emerging from Latin America, many investors believe gold's role as a defensive asset remains firmly intact. Venezuela, a new geopolitical flashpoint. The U.S. intervention in Caracas, reportedly involving civilian casualties, has added a new layer of risk to markets already grappling with instability in Eastern Europe and the Middle East. How the situation evolves will be critical. A diplomatic resolution between Washington and Caracas could calm markets and limit further upside for gold. However, any escalation, sanctions, or regional spillover could keep demand for precious metals elevated. Venezuela's importance goes beyond politics. The country holds the world's largest proven oil reserves, making any disruption a potential threat to energy markets. The crisis also tests U.S. foreign policy under the Trump administration and highlights how quickly regional conflicts can ripple through global asset prices. The immediate response from investors followed a familiar pattern, a move away from risk and into defensive assets. Gold, which performs well during periods of uncertainty and low interest rates, benefited from both dynamics simultaneously. The Fed's role, monetary policy, expectations support gold. Geopolitics is only part of the story. Gold continues to receive structural support from changing expectations around U.S. monetary policy. Markets are bracing for a busy economic calendar this week, including ISM-PM data, employment figures, and speeches from Federal Reserve officials. These events will shape views on whether the Fed is moving closer to cutting interest rates. Speculation that President Trump may nominate a more dovish Federal Reserve chair has further strengthened gold's appeal. Concerns over central bank independence and a looser policy stance have increased interest in bullion as a hedge against currency weakness and policy-driven inflation. According to the CME FedWatch tool, markets are pricing in multiple rate cuts over the coming quarters, with some expectations that short-term rates could drop below 3% by late 2026. Lower rates reduce the opportunity cost of holding non-yielding assets like gold. A softer U.S. dollar, partly driven by these expectations, has also boosted demand from overseas investors, making gold more affordable for buyers in Europe, Asia, and emerging markets. Gold tends to outperform when real yields decline, said a London-based alternative asset fund manager. Right now, slowing growth, easing policy, and geopolitical stress are aligning in gold's favor. Silver steals the spotlight, while gold remains the anchor of the precious metals market. Silver has delivered even more dramatic gains. The metal soared 147% in 2025, marking the strongest annual performance in its history. It reached an all-time high of $83.62 per ounce on December 29th. Before easing slightly, silver's strength reflects its dual identity. It functions both as a monetary asset and a critical industrial input. Its designation as a strategic U.S. mineral, combined with supply constraints, has intensified investor interest. Industrial demand continues to surge, particularly from solar energy, electronics, and electric vehicles. China's rapid expansion of solar capacity has driven record silver consumption, while mine supply struggles to keep pace. At the same time, silver often tracks gold during periods of monetary uncertainty. The gold-to-silver ratio has dropped from levels above 90 to around 60, indicating silver's recent outperformance. Some analysts believe silver still has room to catch up with gold, while others point to strong industrial fundamentals as the key driver. Central banks, a long-term bullish force. One of the most significant changes in the gold market over the past decade has been the rise of central banks as major buyers. Since the 2008 financial crisis, and especially in recent years, central banks have accumulated gold at the fastest pace since the 1960s. Emerging market nations such as China, Russia, India, and Turkey have led this trend, seeking to diversify reserves away from the U.S. dollar and reduce exposure to sanctions risk. Gold's appeal lies in its neutrality. Unlike government bonds, it carries no counterparty risk and is not dependent on any country's political decisions. This makes it uniquely attractive during periods of geopolitical fragmentation for European policymakers and investors. This steady accumulation signals a gradual but meaningful shift in the global monetary system, one that could support gold prices for years to come. Platinum and palladium, different drivers. Same momentum. Other precious metals also joined the rally. Platinum rose to $2,190.55, after touching a record high above $2,470 last week. Supply constraints in South Africa responsible for about 70% of global production and rising demand from the automotive and hydrogen sectors have fueled the move. Platinum is also benefiting from substitution. As automakers replace expensive palladium with platinum in catalytic converters, palladium's outlook is more mixed. While supply remains tight and demand from China is still strong, the long-term shift toward electric vehicles poses challenges. Nonetheless, near-term fundamentals continue to support prices. Technical signals and market positioning. From a technical standpoint, gold's break above $4,400 removed a key resistance level. This opens the possibility of a retest of December's highs near $4,550. Particularly if geopolitical tensions intensify or economic data reinforces dovish policy expectations. CFTC data shows that speculative positions were reduced late last year as traders locked in profits. This lighter positioning leaves room for renewed buying if fundamentals remain supportive. That said, gold is not immune to volatility. A stronger dollar or improving risk sentiment could trigger sharp pullbacks. As seen during previous corrections, what to watch next. Gold's direction in the coming weeks will depend on three major factors. U.S. economic data, weak PMI or jobs data would support rate cut expectations. Federal Reserve communication, dovish signals could push gold higher. Geopolitical developments, especially in Venezuela, Eastern Europe, and the Middle East. For European investors, the Venezuela crisis is a reminder that global risks can emerge suddenly and spread quickly. In such an environment, gold continues to serve as insurance against the unpredictable. Gold's enduring role in an unstable world. The surge in gold prices reflects more than a short-term reaction to events in Venezuela. It highlights a broader shift in investor thinking, one shaped by persistent geopolitical risk declining confidence in fiat currencies and expectations of easier monetary policy with politics, energy markets, and interest rates all pointing in the same direction. Precious metals are once again at the center of defensive portfolio strategies. Whether gold breaks above its previous record will depend on how these forces evolve. But for now, investors appear convinced that in a world marked by uncertainty, gold's centuries-old role as a store of value remains as powerful as ever.